Hello, everyone. My name is Phil, and I am one of the business relations person of Chicago DealVault, and as well as with Home First Realty Incorporated. So allow me to introduce our guest speaker today. He has over 30 years of experience helping Chicago home buyers purchase tastefully remodeled homes at very affordable prices. And his main goal is to raise the living standard in Chicago without breaking his client's bank and with a desire to help others to ensure that a property is up to the high standards. So um, he is a top real estate producer, neighborhood builder, Chicago home specialist, and the owner of Frank Maltro Homes. Friends, help me welcome Mr. Frank Maltro.
Hi, everybody. Frank Montrose, King of the South Side, baby. And
Yeah,
Phil, I hit the 40-year mark. So I've been in business for 40 years. I've been through multiple shifts. I've seen like six. I want to six. Yeah, six. This would be the seventh major shift that I've seen. And there's a lot of noise in the background. Can we mute that or whatever that is? Thanks.
okay, I already
Thank
did.
you. Okay, great. So, yeah, well, we can just jump right into it. So, the one thing that I'm a big fan of is data over drama. So there's a lot of drama going out there. And what people don't understand is that the pandemic housing boom has fizzled. It is over. And we are now going into a correction, which happens after a spike. So, the real estate in the long run always goes up. If you buy a home, even when rates are high, and you get a payment that you can afford, over time you build equity, and over time the house goes up. Now, during that long term time, in the short run, there are um, spikes. So you may say a shift up, you may say a shift down. So obviously, we went through a major shift up with the pandemic, and we've seen things that we've never seen before. One thing we saw where it was interest rates go down below 3. The only time that I've seen interest rates go in that playground is one other time, in another situation where the market crashed, and the recovery was with lower interest rates. So that being said, we'll get into it a little bit more. But if people are concerned about the market, understand that it is normalizing. It is not. It is not in a crash mode. There's a big difference between the market in 2008, where the market crashed and it had to crash, and today. One of the biggest things is that's driving fear into people is the media, and the media is the media makes its money by getting eyeballs to watch the program, and so what happens is for them to get eyeballs to watch a program of real estate, they promote fear. They promote inaccurate data that supports fear, and so they get more eyeballs. Hence, they get more sponsors. So, watching TV, watching the regular news, you're going to get a distorted view of reality. Perception is not always reality. Reality is reality, period. One of the things as the market turns to a normal, sorry about that. Can you still hear me?
Yes,
Yes.
loud and clear.
can
Okay,
you?
sorry. My phone rings occasionally. So, okay. So, um, one of the things to keep in mind is the historical interest rate is 7.8%. So we're not even there yet. I mean, we're getting close to it, but we're not there yet. And that's the historical average. I got in the market in 1983, the last day of June in 1983. The interest rates were 14.5%. People were still buying and selling real estate. People were still making money. Don't listen to the naysayers. I'm gonna show you and tell you why they're there's always a good time to invest in real estate. So one of the things that is important for you to understand is the concept of hyper local versus national, even versus I've seen I see posts and podcasts of people saying, hey, invest in this neighborhood, invest in that neighborhood, and they're comparing like if when you compare numbers from 2021 to 2022, you have two separate markets, two totally. In 2021, the market was going up, and you had the pandemic. You were hot in the pandemic. We had multiple offers. We had 20, 30, 40 offers in at one time. That is not happening now. So the market doesn't have as many buyers. The market time is going to extend. So we'll get more into that. But I want to let you know that one of the key concepts that you have to learn, and a lot of people come to me, a lot of realtors, a lot of investors come to me and say, "Hey, I'm looking to buy this house. Can you help me?" And absolutely, I extend this to the Hugo Group. I will gladly give you an idea of the ARV. With my investors, I support an ARV based on data, on hyper local data, and I'll get into more detail as we go along what I mean by hyper local. So also what I do is I have a FHA VA conventional appraiser on staff, and I have them verify the number. So when I give you a number, it's been verified through me, through 40 years of experience, and it's been verified with an appraiser. So a lot of people are saying, oh, the numbers for Dalton have gone down value wise. But see, you take any subdivision, any suburb, and when you look at Dalton, for example, Dalton has many different sections. They have like a quadrant, and the quadrant that is worth less is the one that's further north, and the one that's worth more is further south toward South Island. The one that's further north that butts up against Harvey, the housing stock sells for significantly less. So if you compare, like let's say you take 2021 numbers with Dalton, and you take 2022. Well, 2022, more housing stock is selling further north. So the numbers are going to be skewed. So you can't just go by a suburb or even an area in the city, one of the 77 communities. You have to go case by case, house by house, apartment building by apartment building. Many of the things that national numbers, even local numbers, are that don't take into consideration. For number one is the style of house. So if you're closing houses that are worth more, that are more desirable, like ranches and like bungalows, they're going to be worth significantly more than a Georgian or Cape Cod. So when you hear, hey, the houses in Dalton are going down, yeah, but what compare apples to apples, not apples to oranges. You can't just take a number and compare it year after year. You have to look and so what we do is we do things differently. So I'm going to look at what if you come to me and say, hey, I've got a bungalow in Chatham, all right, and I'm like, where in Chatham? Because East Chatham and West Chatham are two different worlds, and the values are dramatically different. As a matter of fact, we just set a new standard for a bungalow, and I just closed a bungalow, I believe it was 2 weeks ago, for 410,000. There hasn't been anything that's priced in that range. We know how to package it with appraisers to maximize returns. So when you're looking at hyperlocal, the definition, as I see it, is you have to go into the area, and then you have to look at the area, and you have to look at houses that are closest in proximity. And if it's in the suburbs, a lot of the suburbs It's different based on the perimeters of the suburb. What's bumping up to it? So you have to pay attention because if, like I said, if you go north to Dalton, housing stock is worth 30, 40, $50,000 less. So you need to understand that, and you need to understand area makes a difference. The area inside of the area makes a difference. The style of house makes the difference. So the square footage makes a difference. So what if three bungalows closed on the same block? They could be worth significantly different because if a property is worth, if a property has 500 more square feet, and the appraiser gives it an extra $40 a square foot, there's a $20,000 swing. Now, if you look at that and you're looking at another bungalow on the same block, but you're not aware of the square footage difference, you may think your house is worth as much. If you're 500 square feet less, you may think your house is worth as much. So listen, um, I appreciate when I listen to somebody talk about numbers and group numbers together, group subdivisions together, which market's hot, which market's not, and there's trends that are important, but you have to look at hyperlocal. Another thing too is we've had I've had, for example, I've had a bungalow in Beverly that I sold, and we saw another bungalow in the same block, but it was next to a dilapidated multi-unit building. I knew right away that that house was going to sell for significantly less money because your buyers, there's the bank price and there's the price that a buyer is going to pay for a property. So if you're looking Look, and that house ended up selling for $40,000 less. Exactly what I said it would. We didn't buy the property because we weren't able to get it for $40,000 less wholesale wise. Somebody else bought it, and he sat on it for a year and kept reducing it, and it sold for exactly what I thought it would. Because there's exterior influences. If you buy a single family house and you've got multi units all around, people don't want to live. And buyer's value is a lot significantly less than a bank's value. Bank's not buying a house, buying a house. The buyer's value trumps a bank's value every time. So you can listen all you want to your blue in your face. I have people come to me after I do seminars and are like, hey, I just want to let you know I follow you. Where you buy, I buy. And I'm like, look, that's not necessarily a great thing to follow because if you're not using the dynamics that we use, you could end up getting into a lot of trouble. There's a lot of exterior influences like the multi-unit surrounding a single family. If it's on a busy street, if there's a lot of commercial around, if the surrounding area has a lot of board ups, has dilapidated houses, that significantly depreciates the value for a buyer, which ultimately is the value that we need to look at. And that's where my expertise comes in. That's why I'm a top 1% producer for over 40 years, because I've learned that from the beginning. Just because a property is worth $400,000 does not necessarily mean it's worth that to a home buyer. So you can look at all the data you want to, group it town by town and suburb by suburb, but you have to look even further, and you have to make a smart decision. So I've seen a lot of investors end up losing their shirts because they've kept it. They've listened to people that say, hey, look, the trend is this, the trend is that for this sub. This is a hot suburb, and I'll talk about areas that in general that are doing well. And it's important to understand that, especially if areas are significantly changing, then that's what you really want to watch. And I'll get into that as toward the end as well. Some of the things that you want to look at is you want to look at days on market for properties. And the reason why that's important is because the market is shifting, and it's not going to be this hot, crazy market. It's going to be a normal market. So a normal market A hot market is 1 to 2 months. A strong seller's market is 3 to 4 months, and then 5+ months you're into a buyer's market. So you need to figure out where you are, because what is your biggest expense as an investor, as a flipper, is your holding time, because your expenses rack up, and that depletes your profit. So you want to pay attention to your days on market. You want to pay attention specifically to the style of house, to your exterior issues. What are the odds that the property will be worth X amount of dollars, and how fast can you sell it? Because that, like I said, that affects your value. You need to, we pay very close attention to price. So what I mean by that is, I'm not only, especially now, I'm not just looking at general numbers. What I'm looking at is what's way more important than running hey, 2022, the numbers are here. Yeah, but what is the number for, if I'm looking at a bungalow, what are bungalows selling for in the past couple months? What are they listed for? Because guess what? I mean, I've seen in the 40 years, I've seen properties that were selling like hotcakes, and then the market shifts, and then people start listing houses for 20, 30, 40,000 less. And the active homes that are listed for less are going to go under contract, and probably are going to be sold by the time that you put your house on the market, and those are the new comps. So we like to look at current uh, active homes. We like to look at homes that are under contract. Everything, the closer to the current timeline, the better. And if you could find activity in the past 2 months, that's far more accurate than saying 2022 prices are this, 2021 prices are this. That's irrelevant. That when you compare to, when you look at things hyper locally. So what I'm going to talk to you more today is this isn't I can throw all kinds of data at you and all this, and all these numbers and stuff, and impress you with numbers. In the long run, they're not truly meaningful. They're not truly accurate, and they're not going to protect your investment, because what you want to know is, what the ARV is, and how fast can I get that money in my pocket so that I can buy another investment. Ultimately, that's what you're looking for. Um, Style of homes, there's certain style of homes that people prefer. In the city of Chicago, the bungalows and the ranches are more desirable for a multitude of reasons. I won't go in there and bore you with that. But anytime you want to give me a call, feel free to, and I can explain why. Cape Cod's, Georgians, buy levels are on a second tier. They're not as desirable as the ranch or the bungalow. So when you're buying a style, that that house may sit longer. A Georgian at Cape Cod, except if you get out in the suburb, you get in Lansing, where many homes are Cape Cod, that's a different story. More people are expecting that, and they're looking for that style. So that doesn't affect. So again, hyper local. What's common in the area? What style of house sells more in the area? Big, big deal. So well, yeah, but Frank, in 2022, the 40 houses sold in this market, and at such and such price. What does that have to do with the specific house that you're buying? It gives me an idea of a trend, but it doesn't tell me what the ARV is. And you want to know what the ARV is. So what I'm giving you today is far more valuable than me spouting out, what the general numbers are. I will give you my opinion at the end of what areas that I like and what areas to be very cautious, and where I see major shifts going on. Okay, some things to look at right now, and this is the biggest protection in this market right now, and this is why the market has not radically changed, is that inventory is low. Nationwide, inventory is low. Locally, inventory is low. You could look through every town, every uh, suburb. Inventory is low. What does that do? That protects sellers because like in 2008, when we look at why was, in addition to all the bad loans and everything, there was over 3 million homes nationwide, and the inventory was huge in Chicago, and we had a lower buyer base, so we had more inventory, less buyers. It is now, it becomes a buyer's market, a strong buyer's market, and that's why the market corrected so drastically, because of all the other elements that were going on, all the perception that the market was crashing, which it was, and now we have just the opposite. We have a very low inventory, and everything that all the top guys are predicting that it's going to be this way for a long time, for 5 to 10 years. So if you have low inventory and you have a strong buyer base, and everything I've read shows that there's going to be a high buyer base for at least 5 years, and I'll explain why in a second. And even after that, there's going to be a strong, not as strong, but still a strong buyer base, higher than the inventory. So that we're still in a seller's market. We are still, now the days on market is going to correct. So you can watch that, but watch it hyper locally and find out. Don't just say, hey, what's the average home in Dalton, in Dalton right now? Well, where and what style of house is what I would ask. Let me look at that and let me get you a true number, because it doesn't matter what in the long run what the general numbers are. The buyer population is influenced by first-time home buyers. First-time home buyers, the average age is 33 years old. Okay, so when you go back in 2008, one of the reasons why there was a low buyer pool is because you rewind 33 years. 1973, Roe v. Wade passed. The buyer population went dramatically down from 73 to 77. So in 2006, we were already seeing the market shifting, and then 2008 with the crash of all the foreclosures and the flooding of the market of inventory, that was why we had a crash versus a correction. Now we don't have that. Now we have we had a spike in people having babies from 88 through 91, and even after that, buyer population was huge. So that's you translate that 33 years later, we have a strong buyer pool, and the next issue is perception, and so and I'm going to tie that in with affordability, because excuse me, listen, you can listen to all the garbage on TV, all the sensationalism, all the fears and lies that they spew, or you could look at the facts of what's going on and understand the market. Um, Affordability is decreasing with buyers, which means that, but what buyers will start doing is buyers that want to buy a home, if they buy into the false perception, they may wait. However, I'll explain why it's critical that you don't wait. And one other thing too that the media doesn't tell you is that, and I think we all know this, a lot of people's incomes have gone up dramatically. So what all they talk about is the interest rates going up. They don't talk about your home payment is not your entire income. They don't talk your home payment is a quarter, a quarter, 33%, whatever whatever you decide to spend. It's not your entire paycheck, and paychecks have been going up, specifically in the better jobs. I mean, even in even in the jobs like dishwashers. I mean, they were making. I remember talking to a guy that was a restaurant where he was paying him $12 an hour, and now he's having a hard time filling a dishwasher position for $25 an hour. So when you're talking about affordability, You need to understand it's not as bad as people think that it is. But it is not. It's not good because as the interest rate goes up, for every 1%, you're going to lose at $200,000. You lose $20,000 of purchasing power. So if you're looking in a very high end area, what I see with our buyers now is that they're starting to compromise their stance on locations, and we're talking into moving into locations. We want them in houses so that they can build equity. If you hold on to a home for a long time, you will build equity, and you will fire your landlord, and you will make yourself rich and not your landlord rich. And that's the message that we send out to our home buyers so that they continue buying and they don't get sidetracked. Because if you stay and you rent, I mean, CNBC, has a speaker out there. A broadcaster. She's been saying since 2014 to, it looks like my screen's frozen. Can you hear me? Hello, hello, hello.
Yes, we can hear you,
Okay.
Frank.
Okay, got it. So since, they've been saying since 2014 um, a, not to buy a house. And, imagine the equity that, people would have lost, even during the pandemic. I mean, I've seen homes increase up to 50% in value, and a lot of that is inflated equity, and so some of the values in those areas that I'll get to in a second, they're starting to normalize and adjust back to reality. But the deal is this: if you're going to buy a home and hold on to it for a year to 2 years, now probably is not the right time to buy until we have some more clarity on inflation. However, if you're planning on holding a home for 5 years or more, it's always a good time to buy because you will build equity. So we have inventory. We talked about buyer population. I mean, the economy, unemployment is low, which creates a lot of buyers. Um, Supply and demand are the key issues right now for curbing inflation. So, everything I've read is that the supply chain is going to be improving in the fourth quarter. So that will help. With inflation, and the Feds are raising the interest rates, so that will curb demand. And as demand goes down, inflation goes down, and interest rates go down. So those are some good things that are coming our way. Nobody can predict. Nobody can predict what's going to happen because we don't know when this inflation is going to end. Um, Everybody I talk to is saying that what we see right now is going to remain anytime through the first quarter through 2023. Keep in mind, the average recession lasts around 2 years. And I'm not saying that it can't last more than 2 years. I'm just saying over the 40-year span that I've been in business, I've seen the average recession last about 2 years. So affordability is just not interest rate. It's just not price. And this is the other thing that people don't understand. It's about your payments. So if you're not able to buy in a certain area, you can buy a home in another area, build equity. So when rates come down, you can sell your house and buy in another area. We have a saying: marry the house, date the rate, fire your landlord. It's critical that you as sellers too convey this to home buyers that are looking at your house. It's important to get the house. You can always refi. That's always possible. So if rates happen to dive again, you can always end up refining and getting a much lower payments. But payment is the key, not just uh, price, not just interest rate, and not just taxes. And so, what else is happening now with the market shifting like this? You're going to see a lot more aggressive programs out. There's zero down programs. There's programs that will allow buyers with 580 credit scores within reason. I mean, I'm not talking about a 580 credit score that doesn't make payments on time. I mean, there's 580s that should be 380s, and there's 580s that should be 680s. But the people that show a propensity to make payments, house payments, even if they're at a 580 and they don't have any really bad derogatory credit recently, we're getting them into homes now. And so things are not as bad as they were in the early 2000s, where anybody can get a house, no matter what your credit score was or your income was. It's not like that anymore. It's more like it's starting to go back to the days of banks in the early, the early 1900s and those eras, or that where people look at they look at, do you have an ability to make payments? Do you have ability, and that's superseding the higher credit scores. Credit scores are going to be relaxing. There's zero down payment programs coming in. There's more grant programs coming in. So there's programs. Look, uh, mortgage applications are down nationwide, and they're down locally in the state of Illinois too. And I know this because I talked directly to the vice president of Chicago Title, and he confirmed some numbers for me that the month of July they're down 33%. So look, the buyers are a lot of buyers are staying on the fence, and we're talking them into, and we're running seminars and explaining to buyers why it's always a good time to buy. So one other thing I do want to mention is taxes in the city of Chicago. So one of the issues is with homes valuing up so much, the city of Chicago is going to come in and reassess homes, and they're going to raise the taxes. And fortunately, on the south side, it's not substantial. Where it will be substantial is more in the luxury end of the south side. They will see bigger swings in their taxes. But the tax increases that are coming for the South Side are not going to be substantial enough to make a huge impact on buyer affordability. Okay. Opportunities. Where, so for a home buyer, there is the opportunity to buy a home. As I mentioned, in the long run, real estate goes up. If you buy holds, you build equity. It's a great time to buy. When I got in the business in 1983, the interest rate was 14.5%. People were buying homes. People that bought back then have paid their homes off. They have equity, and they have generational wealth. They didn't wait till the rates came down. They bought payments. They found a payment that they can afford. They got a home, and then a lot of them bought a home that they looked at as more of a starter home, and then they build equity up. 5, 10 years later, they were able to buy their dream home. Um, Waiting on the interest rate to go back down. I've only seen the rates that low in two times in 40 years. So you're going to be waiting a long time. You're going to miss a lot of opportunity. You're going to make a lot of landlords rich. And I don't think I have to tell anybody, especially those out there that own rental properties. I mean, I've seen, I looked at in Orland Park, for example, there's some townhouses by the Marianos at 143rd in LaGrange. It wasn't very long ago, several years, I think 2, 3 years ago, they were rented out at 2,500. Today, they're renting out at 4,000. I mean, look, it's hard to, if you're renting and you're paying a premium dollar to rent, it's hard to save money for, excuse me, for a down payment. Sorry, got a dry throat today. Allergies are up. So, um, what do you do when you buy flips? You know, you're looking to flip a house. Well, you have to be extremely knowledgeable. And you have to, if you're not knowledgeable and you don't have time to do that, you hire someone like me who's going to give you hyper local information so that you protect your investment. It didn't matter in 2021 because values were going up through the roof. People saw houses that were worth $250,000 be worth $350,000 overnight. It didn't matter so much. You know, you could be sloppy. You didn't have to be specific on your analysis. Now it's just the opposite because now areas are adjusting and they are going down. And I'll get into that right now. So um, areas that I like are areas that have a lot of services to provide, and those are the ones that become more stable. Specifically, South Highlands, the values are always extremely stable, and they're actually increasing. Beverly, same thing. So they have restaurants, transportation, stores. People want to live in these areas because of the services. So those areas remain stable. Areas that have been undervalued, that are increasing. My favorite is Chatham. Like I said, we just sold that one house for 410,000. We set a new bar. Um, Suburbs that are bulletproof on the south side. Oak Lawn is another area that has just a ton of restaurants and services. We always love us some Oak Lawn. If you want to get out a little west, Bellwood has always been, compared to other areas, Maywood, Oak Park. It's like the cheapest area to live in that area, and get tap into all the services of the other towns. So that area always does well. Even I've seen it even in the crash in '08. I did extremely well in Bellwood. It just brings a lot of buyers there because it's so affordable, and you don't have to pay Maywood or Oak Park prices. The other thing I'm noticing now is that, so what a lot of home buyers are doing is they can afford 2 flats, 3 flats. So that market is still hot, and it remains stable in a down cycle. So you need to be looking at, if you're going to start flipping, twos and threes, especially 2 flats, because it's not for the most part it's not cost prohibitive. When you get into 4 flats, it's tough to make a profit off of that, and those are better in the buy hold areas. And I've got a friend, Jared Cott. He owns a lot of doors, a lot of rentals, and he's been asked, hey Jared, have you ever made any bad buys? He said, of course I have. And they're like, oh, that's too bad. He goes, no, it's not. He said, because I hold on to my rentals long term. So over time, I'm going to pay it off or pay it down. I've got equity built, and so when it comes to rentals, he's a little more aggressive in buying. He may spend too much at that time, knowing that the money play is on your rental door, your per door, and building equity over time. So each case presents its own challenges, and you have to set your philosophy and understand what you want. Areas that I'd be very cautious. So the area that's just east of Beverly, West Washington Heights, the west side of Washington Heights. So that area is shot up, and the reason why it's shot up is because it's so close to Beverly and Beverly services, but it's abnormally shot up, and it's already starting to adjust. So I mean, homes went from 250,000 to 375, and now they're coming down, and it's readjusting back in the low threes. So you have to pay attention to what is closed in the last few months, not what's closed a year ago, not what's closed this year, but what is the current trend. That's far more important. um, Auburn Gresham, I mean, that area that area spiked like crazy during the pandemic, and the reason it did is because in Englewood is because people compromised their values, their areas, and they said, "Hey, I need to buy a house, and these rates are low. I'm just going to go in these areas and secure a home. And even though I don't want to buy in these areas, I'm buying the house. I'm buying the lifestyle. So that's why those areas went. Now that values are starting to adjust in those areas because buyers are not looking in those areas. There's not that pandemic of buyers that are there. So because the days on a market is starting to normalize and values in certain locations like that are starting to normalize, more and more buyers know that look, they're not necessarily in a rush. They don't have to move right away and put an offer on a property like they did in the pandemic. I mean, I remember we had a house in Homewood. We had 40 offers in 3 days, and my clients like shut it off, deal penned it. I said I'm getting stressed out from all the offers. That's not around anymore. So the market is normalizing. Buyers are making offers on property. Buyers are asking for closing cost credit. So I mean, prior to that during the pandemic, they were waiving everything, and that was highly unusual, never seen before. Probably won't see it again for another 20, 40 years. So don't look for the market to return back then. If you were able to take advantage of it, great. If not, play the game that's set up for you now. Now, one other area that's unusually spiked, but it was way undervalued was Roseland. I mean, literally overnight, values doubled in Roseland. So I don't know where that's going to adjust, but the big frame houses are definitely going to come down, and so be careful with those. The ranches in West Pullman it's always been fairly stable. I'm not concerned about those areas. The numbers are still holding up strong there. So those are some of my picks for areas that I like. But the deal is this: look, you can make money as long as you have a decent block, decent area, decent house, great layout. I mean, some of these houses also have horrific layouts. I mean, I wonder what they were thinking when they laid the house out. We go in, we move walls, we make it current to today's standards, and we make it where we create an amazing lifestyle, and that's what sells the house. So people buy lifestyle. That's what we sell. So, guys, that's my recommendations, and I hope that you guys took a lot of notes, and I hope that you start learning to buy hyper locally. If you want to hire me, I'm available. I have a big team, all trained by me, and we'll be more than happy to help you. If you want to reach me, my cell number is 708 307 0777. 708 307 0777. I would prefer that you text me first because I'm in a lot of meetings pretty much every day, and it's difficult for me to answer. I can answer a text a lot easier in a meeting and let you know when I'm available. But glad to help anyway. And if you're stuck on a property, I mean, don't call me every day, but unless you're my client. But if you're not my client and you need help with the property, and you're part of Hugo's Mastery, I'll be more than happy to help you determine what a true ARV is from a buyer's perspective, not just from a bank's perspective. So, Phil, that's it. I don't know if there's any questions. I'll be glad to answer any questions now. You can call me later. Also, if you have any questions, be more than happy to help you out.
Right. Thank you so much, Frank. Do you have questions? Do we have questions for Frank? We can entertain questions for 5 more minutes.
One thing, hey, is Hugo still there?
Yeah. Hugo, are you available? Um,
Hu
um,
yeah, Hugo, just have Hugo call me afterwards. I need to run something by him, but
oh,
that's
okay.
it. So, any questions that I can help you with now?
I don't have a question. Well, if you don't have a question, I would like to thank you, Frank, for the knowledge and updates you have imparted to us.
Glad to
Guys,
help.
feel free to reach out to the King of Southside, Frank Montreux. We posted his phone number on
Mhm.
the chat. Also, yeah, feel free to send an email to support at chicagodealvault.com if in case you have questions for Frank. We can always relay the message to him as well. Thank you so much, Frank, for today.
Peace out,
Thanks,
y'all.
Frank.
Thank you.
Thank you very
All right.
much.
Thanks, guys.